podcast. I'm Simon.
I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. And Simon Glastonbury is an independent mortgage broker with 25 years of experience providing mortgages, bridging, and development finance for home buyers and investors. And Simon is joining me today on an episode that's going out on Christmas Day to talk about mortgages, because what could be more festive? Well, unfortunately, it could have been more festive because we were hoping that the Bank of England was going to give us a nice Christmas present last week, or yesterday as we're recording, but it didn't happen. So what did the Bank of England fail to provide us?
Well, Simon, great to be back again. Happy Christmas. Not the Christmas we all wanted, and to be fair, not the Christmas we were expecting. I think a lot of media outlets were predicting that we would have another 0.25% rate cut in the Bank of England base rate. We talked about it on the last pod. Great expectations of that coming down. Again, little did we know what was to come our way. Interesting voting. It was 6-3 in favour of keeping it as is. So there is definitely a feeling within the decision makers to then reduce rates. So I think, no, it's not the Christmas we wanted, but I'll caveat that in a second with rates and where they are and where they have been. But I'm expecting that in the new year. So I think there's good times. Let's go at good times on the horizon. Good times for 2025. So I would certainly expect a 0.25% rate reduction early 2025. Banks are then building into that another rate cut before the middle of 2025. We're going to be hopefully down. We should be down at 4.25. We can hope we're going to be down to 4 at some point next year.
Well, that sounds very promising.
I know. What good news? Absolutely. I am bringing good news. It's like I feel like Father Christmas. But at the moment, I mean that's it. Now, I'll then switch that over. What's not so good news? From when we spoke last time, it was obviously they've just come down. And so we were, of course, inundated on the day after. Right, okay, my rates, can I have a better rate? The base rate's come down 0.25%. They've got to reduce. To our horror, and it really was to our horror, pretty much to a man, all the banks put their fixed rates up after the Bank of England base rate cut.
That's just not how it's supposed to work.
No, that's not. It's just not cricket, as they say.
No.
It really did. It kind of bamboozled everybody. It certainly bamboozled everybody, unless you're in the mortgage market, unless you're in the money markets and interest rate market, because they were already built in. They knew they had a good idea what was coming. They have a good idea. And it's all, there's a lot of this, even from the bank side of it. It's a lot of guesswork, what might happen over the coming year, 18 months. So they've got to factor a number of things in. Do appreciate that. But of course, the media don't get hold of that. And then, of course, we're inundated, and the confusion from clients, customers, buyers, remortgagers, it's all over the place. What on earth is going on? But that happened, and then they put them up again. It was just a stepping stone of it was a horror show for us, and really, I can't remember a time it's gone that way. Usually what would happen, base rate would come down. Normally what would happen, the 2-year and 5-year fix would follow. They don't tend to mirror, don't get me wrong. They don't come down 0.25% along with the base rate, but they do tend to come down. So it would sort of start us guessing and say, well, what do the banks know going forward? And I think we've had a lot of conversations about this over the last few weeks. And I think everybody's got to get it in their own mind that this is pretty much where rates are going to be. If they're building that in, I mean, you may see some fixed rates drop slightly over the next 18 months. But I don't think, although Bank of England base rate is coming down, I don't think they're going to follow, or they're certainly not going to mirror what you see there. And the banks are tending to, at the moment, just before the base rate falls, they're upping fixed rates. So they're increasing them without a great fanfare. And then when they're down, it then gives them the flexibility to go out to the market and say, look, we're fantastic. We've just brought the VIX rates back down again. And of course, you're back to square one. And I'll do a quick roundup at the end of where we are, and you'll be able to see we're actually slightly higher than when we discussed 5 or 6 weeks ago.
So they put the rates up after the Bank of England rate went down, but then they have brought them down a little bit again since then, have they?
Correct. Yeah. So they increased them up, and depending on which lender, which market they're in, be it mainstream, be it specialist, depending on how much they put the rates up by. But they put them up. Some of them put them up twice, and then they brought them back down again. But they're still slightly higher than where we were before the rate cut. So we're just sort of, we're pretty much where we are.
Yeah. So going into next year, you and the rest of the industry and things are expecting Bank of England rates to come down early 2025, and then again, you said before mid 2025. Should we expect the actual available mortgage rates to sort of come down a little following that? I mean, as you said, not exactly mirroring, but come down a little. Or do you think that is what's already baked in, and effectively that means that the rates will stay the same as that transition happens?
I think that's the burning question for everybody, and everybody's trying to second guess the banks. The banks are trying to second guess, and of course they've got the. What I'm sort of starting to think is they'll have targets as soon as the years out. They'll have targets for 2025. Generally, they'll increase up from 2024. It hasn't been a great year for mortgage lending in 2024. They've certainly not broken any records. So if they want to get back into that market and they want to start making money, common sense would say, right, they've got to be a little bit more aggressive against their competitors. And there's clearly some sort of leeway there, a margin there for the banks to make some money. But it's a case of how much they want, how much market share. None of the banks, it always gives us a good indication in the market of how busy they are. If we put an application in, how quickly are they turning it around? At the moment, pretty much every single lender is turning things around within a day or so. Very, very quick. You can get them on the phone. You can see. So clearly they're not as busy. They'd probably like to say, oh no, our service is just brilliant. But in fact, it's just because they've not got very much to do. So that would, I think that you may come in for 2025. There are lots of indicators to say that the market is picking up a lot more. There are a lot more property. You can get that information on the likes of Rightmove and Zoopla to see how many properties are around, see how many are available in whatever sector you want to. And we're seeing it. We're definitely getting a lot more inquiries where people are putting their property on the market or thinking of putting their property on the market. What can I get? How much can I borrow? That's been quite significant over the last few months. So it just tells me that people are now getting used to rates at 4.5% in a residential sector, and they're factoring that in. And then anybody in the investment side, so if you're looking at buy-to-lets, which again, the inquiries are keep creeping up. And I think also the problem in the buy-to-let side is not necessarily the rate, availability of property. Investors will definitely look at properties generally in a little bit more detail because they're looking at the rental market, they're looking at they're looking at potential resale. So in that sense, and the properties are just not there. So although they have cash available and you can factor in the different amounts they're going to be paying, budgeting, going forward in cash flow, actually, if the properties aren't there, they're not going to buy. So It's got to start from the bottom up. So whether the bottom up generally being first-time buyers or investors. Now, first-time buyers are very, very rare. That's it. Heard a stat of 2020. I think it's 2024, 2023. I'd have to correct myself. I think the average age of a first-time buyer was 37. So that's vastly different to where it was 20 years ago. So that market has got to be the sort of 1-bedroom, 2-bedroom starter home rental properties. If they're not being picked up by first-time buyers, if they're not being picked up by landlords, the chain doesn't start, and people can't. So, but I think from the information we're being provided for next year. Definitely more properties on the market. That's got to boost the market. I think people generally, if you just have a chit chat with people now, oh well, rates are 4% now, 4.25%, 4, and it's like, okay, this is where we are. It's taken some time to get to that point, but I think everybody's accepting that. So looking at the rates, looking at Bank of England base rate, I think for everybody, don't take that as gospel that fixed rates will come down. That's not what we're seeing. It's probably not what we're going to expect next year. It would be very hard for a bank if base rate came down, let's say to 4.25% by the middle of next year. It would be very, very difficult for the banks to keep fixed rates where they are. I would then expect them to be in the threes again, top end of the threes in the residential market. But again, as we spent most of this year, the buy-to-let market and the limited company buy-to-let market rates haven't changed an awful lot. We go back to January to now, very, very little difference, and we've had base rate cuts. So will that continue? I don't know. Is that the expectations of the bank moving forward because they've had issues with cutting fixed rates at the same time as Bank of England base rate before? Who knows? It's not something we can really get to the bottom of. A lot of people give you different ideas. All we can do is look at the facts, see what we've got with the rates. And I think we're there and thereabouts for rates for the coming few years. So if people want to buy, if people want to remortgage, I don't think it's a time to wait. I think you'll be just waiting for very much the same in 6 months' time.
Yeah. So something else that we can't be sure about, but to speculate on, are you expecting next year to sort of be busy or busier than previously? I mean, obviously we've got the first-time buyers stamp duty rate, I should say, going up in April. I think it's due to go up. So presumably there might be a bit of a rush for first-time buyers to try and transact in the first few months. And of course, it's the beginning of a new year after the end of a year where everyone's preparing for Christmas and sort of shutting down and stuff. So do you think it's going to be a good start to 2025?
Yeah, I do. I'm a lot more positive for 2025 than I was before. That's for certain. Because you can only go by what the feeling of the amount of inquiries we're getting in as a business. We speak to agents, and if you speak to agents I've known and trusted for a long time, they are out there. You do get a feeling that they're getting a lot more inquiries in. They're getting a lot more property. People are saying, can you do valuations? Can you put them, what do you think? What's around? So I do think it's very, very positive for 2025 because I think people have settled down. And because they haven't been moving, we are a society where we like to move. I don't know the figure exactly. I think it's every 5 or 6 years. We tend to move when we're between the ages of 30 and 55, I think it is. People tend to move every 5 or 6 years. That hasn't happened. People haven't been moving as much as they have historically. Will that go back to where we are? I don't know. I would like to think so because historically, rates are still relatively low. They still are relatively attractive. And if you look at them, if you get the right property, you get the right investment property, it can still be a very, very good investment. And what we're still not seeing property values go down. That hasn't been talked about for a long time. We've gone through periods, haven't we, in history, probably the last 20 years, where we're going to have a crash. We're going to have a crash. It's going to crash. The bubble's got to burst. I can't see that. Yes, you're going to have the odd property which is downvalued because it's overpriced originally. That's always going to be the case. Yes, you're going to get valuers downvaluing investment properties because the landlord thinks it's worth 50,000 more than it is and just wants to take more money out. We get that all the time. But generally speaking, I think the properties, we're not going to be making huge amounts of money on them. I don't think it's a massive growth. But I think we're all fairly happy if there's a 5% growth per year on a property. If it goes above inflation, everybody can sort of sit there and go, well, okay, yeah, I'm fairly pleased. Of course, we want 5, 10, 20% growth. But thank goodness we're not going into that because it just pushes all the first-time buyers out, clearly. So, yeah, to swing back, think it's going to be a really good year. I think it's going to be a good year. We're positive as a business going forward. Don't get to say that too often, but lots of inquiries in. And I think now people have settled into the rate. That's so important. People feel quite good and think, right, okay, well, it's actually going to cost me X. Therefore, and that's where we are. Okay, get my head around that now. Won't get the new car, as people have been doing over the last 10 years with rates at 1%.
Yeah.
That's a very different, we've noticed that certainly, because it's a huge burden on people. As that's come out, right, won't do that. Let's move instead. Priorities. I mean, everybody's different, but I think people are just a little bit sort of, like I say, just a society of people liking to move and better themselves.
Yep, indeed. So let's finish up this episode with a run through the latest available mortgage rates, and we've got a sort of normal selection that we normally work through, and that ranges from residential. Obviously, most of the listeners will be slightly less interested in that. They probably do also own their own homes. So we start from residential, then we go through to personally owned buy-to-let, limited company owned buy-to-let, and then on to more sort of advanced things like HMOs, which would typically be in a limited company anyway. So, given that setup, Simon, what have you got for us?
Right. I have got a little Christmas present in there, which will make you smile. But let's start at the residential first of all. Pretty much, I'm just looking back for 2nd of February this year, and the 2-year fixed rate for a residential property as of today, the best one on the market is 4.34. In February, it was 4.35. So you can, therefore, I'm not going to surprise everybody by saying most of the rates are very similar to where we started the year. Best 5-year, and that's it with a 25% deposit. Best 5-year rate at the moment, 4.18. So we're just over the 4% mark. The 3% rates have disappeared, but you can see, will they come out? Will they try and be quite aggressive and come out with sub 4% rates in the new year? Quite possibly. What's quite interesting, though, tracker rates at the moment. Tracker rate at 75% loan to value, 4.49. Think there's some value in that. I do think there's some value. It's definitely a consideration now because it's getting quite close. That was quite some way off previously, clearly because of the bank's expectation of rates dropping. I think that's quite good. So definitely a consideration if people are out there looking forward, expecting rates to come down. Definitely speak to your broker and talk about that. Going on to your buy-to-let. Here's your little Christmas present, which I promised to give you. Lowest rates if you want to do it purchase something in your sole name, which I appreciate most people don't now. But let's just pretend, because Christmas is full of pretending. 3.24.
Wow, that really is
People need to watch
low.
us on YouTube so they can see the surprise in our faces. And my Christmas present is a 7% fee. They're back.
I thought they'd gone away.
No, they're back with a vengeance. That's it. What they've given us now, lenders have come back with their 7% fees so they can come up there with a ridiculously low rate. I really would love to know how much business they're doing at that sort of level, because it just doesn't make any sense to me. It's a huge, huge, huge fee. I've worked something out on a £262,000 loan, and that's £18,500. Wow. Yeah, I just can't see the value in it. But then you look at that's on a 2-year. If you look at something, most buy-to-lets we look at are on a 5-year because they tend to lend you more. We talked about that on a previous episode. But if you're looking at a 5-year, 4.44 with a 995 fee.
That's not too bad.
No,
not too bad.
No, it's not a 0.3 above where you're just less than 0.3 above where a residential. That's pretty good.
Yeah.
Again, historically, buy-to-let rates were generally about 1% higher than what you get on a residential. They're not at the moment. I think that's good value, good money. So you can see. So the buy-to-let lenders are going in there quite aggressively. So that's got to give us a little bit of hope anyway, minus the fees. Right, limited company again on a they have a ridiculous 2-year at 3.14 with a 7% fee. Can't see anybody going for that. But then again, Five-year rate, again, 4.44, but it comes with a 5% fee. The best one for a limited company I've come up with at the moment, 5.19 with a 1195 fee. Still not horrendous.
Definitely getting a bit more pricey though.
Yeah, absolutely. You can see, go back, strangely enough, I'll go back to the beginning of the year. That rate was exactly the same, 5.19 without a fee.
So it's got slightly worse.
Yeah, so you're about £1,000 down from where you were at the beginning of the year. You then go into the HMO market. There is a 5.19, which is very good. Comes with a 7% fee, or 5.29 with a 3% fee. And they're not very aggressive at the moment. It's something you've got to work out. But again, and there are a lot of others there. It really does depend. When you're looking at, what I would say to people is, if you're looking at something with a percentage fee, it all depends on the value of the property and the loan amount. Sometimes it can work out. I doubt the 7% fee will work out very well. And if as soon as we come up with one as a business, I don't think any of the guys have applied for one as yet. I can't see it. I would question it. But I'll be the first one to shout. But you can see, I'm just looking at now for the beginning of the year. The rates are nigh on exactly the same as where we were. So we've gone absolutely nowhere in 2025, even with base rate cuts.
Well, hopefully next year we'll do better.
We must do. I think the bank or the banks get I'm giving them a D- for 2024. That's the best I can come up with.
Oh dear, indeed. Well, that is it for us in this episode, and indeed for 2024. So thank you very much to everyone who's been listening. And if you are interested in finding out the best mortgage options that are available to you, or getting some help working through comparing 7% fees to 5% fees to 3% fees to some £100 fees, then please do get in touch with Simon Glastonbury. You can find his contact details in the show notes. And other than that, it just leaves it for us to wish you a Merry Christmas and a Happy New Year.
Very Merry Christmas.